your patience as we were going through this issue. This is that bi-coastal Zoom issue. We got people in California and New York and somewhere around the world. But we're good, right, Marvin? I can jump on? Gotcha. All right.
Yes, sir.
Good evening, everyone. My name is Chuck Roberts, and I'm the Vice President of Operations for the Metro New York chapter of the National Black Association. And it is my honor to be here again tonight on another a session of our financial literacy program, which began in February of 2020, some time ago. This is our 7th session of Rewriting Your Financial Future. And with every session, as you all know, for those who've been here before, we try to pick a topic which is going to help improve the financial situation of the community to which we serve. And this particular topic of improving your credit score came up very high as being one of the ones that we needed to work on. It probably should have been the first session, believe it or not, and maybe everything else comes from that point. But so much for that. We're at 7th session right now. I have to be brief because we're running late. I want to thank the people who are here tonight on our panel, Ms. Julie Walker and Mr. Anthony Davenport, and you'll hear more about them in a moment. And also thank our sponsor, Credit Suisse. We're going to play a quick video for them. It'll be about a minute or so, which gives them the right to say a little bit about who they are. If you haven't heard of Credit Suisse, please open an account with them tomorrow. It'll make us very happy. And also, once again, thank you, Marvin Vasquez and MMUSA, for your talent and your support in getting these things done. Last but not least, Andrew Hamilton, will jump in at the end, the president of our chapter, and say a couple of words at the closing. So much for saying my 10-minute introduction. I won't do it right now. Let's play that Credit Suisse video and get into entering into Julie Walker and introducing Anthony Davenport. Thank you.
Why? Why do we get up every morning? What is it that drives people like us? That not only gets us started, but keeps us going. Relentlessly focused. It's them, people with ambitions, who are driven by the urge to seize chances, master changes, progress, who build something that is important for them and becomes essential for others. Something that lasts. They inspire us, make us bring our A game to every meeting, every phone call, every occasion. We are the ones who help them reach their goals. Personal goals, business goals, goals that impact all our lives, or just a single one. No matter how tough the challenge is, we build lasting value with them and for them, every day. We provide solid foundations to leap from and to land on with all our strengths, our experience, our diverse mindsets. This is why we get up every morning. To do what we do best. This is our purpose. We build lasting value by serving our clients with care and entrepreneurial spirit. Credit.
Well, I want to thank Credit Suisse. Chuck, would you like me to take over now, or would you like to say a few more words?
I've said enough. Julie, it's all on you. Thank you very much.
Okay, so
and thank you for being our rock. We really do appreciate you. Bye-bye.
I'm Julie Walker, and thank you everybody for joining us. Anthony Davenport, thank you very much. Let me give you a few words about Mr. Davenport. After graduating from Washington State University, he started his professional career as a loan officer for Bank of America in its Seattle office. His skill as a relationship builder helped him quickly move to the top of the bank's sales team and into the prestigious President's Club, reserved for performers in the top 2%. He moved to Wells Fargo, where he started his advanced training in the intricacies of the home mortgage business. Ironically, it was as Davenport ascended to the highest levels of Wells Fargo that he began to notice the mistakes, misinformation, and pure arbitrary, I am sorry. He saw that there was the credit reports could be arbitrary, and they were costing uninformed consumers tens of thousands of dollars in extra interest on their loans. So as the home mortgage market was being fundamentally altered in the financial crisis, Davenport resolved to go on his own and build a company that would help people avoid the old pitfalls that caught so many of the clients he had seen at Bank of America and Wells Fargo, and the new ones coming. In 2010, Davenport founded Regal Financial in New York City. As a former mortgage originator, he said he understands how unfavorable credit or no credit at all can impact your livelihood. So let me now give you Anthony Davenport. Again, thank you for joining us.
Thanks for having me, Julie. That's such a long-winded way of saying I'm a reform banker. I'm repenting from my old ways, and now I'm helping consumers out on the other end of it.
Okay, well, I could have told everybody that, but this makes you sound like you really know what you're doing, and we know you really know what you're doing.
Yeah, that's true. That's true. But I love to speak to groups like this because, I barely made it out of college. There was definitely not an MBA type of thing that was going to happen for me. And I also, I got to talk to someone yesterday who went to Harvard. And I said, I went to Harvard too. And they're like, oh yeah, where'd you live? I'm like, no. I went to Harvard once, and I spoke about how to establish credit for the soon-to-be college graduates. So groups like yours are great because I love speaking to people smarter than me.
Well, you know what? We're going to let you do a little presentation before we get into the Q&A. So why don't you take it away?
I'm sorry, you were cutting out for a second.
We're going to have you do a little presentation first before we start the Q&A.
Yeah. Give me a second to reopen that because my computer just restarted. But
okay.
Yeah, so I basically want to give you the quick intro into how the credit systems are built and how to navigate them, because this is something that you will not ever get to learn in school or from friends or from family or anything like that. It's just not taught. So my job is to tell you what you didn't learn and help you figure out how to navigate the whole industry of credit. Because the fun thing that I learned about it being on the banker end is that the whole system is designed to make as much money off of you as humanly possible. And they don't want you to know the rules of the game. They're like,
that's the interest. That's the interest.
Yeah, they're like, look, just step in. And I would see people that were making millions of dollars a year at places like Google, where they would come to me and say, I want to get a loan from you, and they had no idea where their credit stood or how to improve upon it or what any of this stuff meant. And I'm like, oh my God, you make millions of dollars a year. You're a really smart person, but you don't know this. And the banks are taking advantage of that. That's pretty crazy. So anyway, I can share my screen now, right?
Yes.
All right. So our company is based in, it was founded in New York. I now live in Los Angeles, and then we just incorporated over the summer and are operating in the UK as well. Believe it or not, they have the same system. We focus on repairing credit, protecting it, establishing it, and then just managing debt in general. We work with some of the most famous and richest individuals on earth. People don't think of them as needing credit advice, but trust me, they need it more than anyone else because the stakes are much bigger for them. When they're looking to get a loan, they're getting loans for millions of dollars versus hundreds of thousands of dollars. And they will pay more for it, or they'll be turned down, and it inhibits their ability to to maneuver around the credit space. I have a book that came out 3 years ago. It made the Amazon top 100 bestseller list in 2018, called Your Score. My publisher would not be happy with me if I didn't mention that. It got in a brief excerpt of it was included in Oprah magazine, which is not a bad idea to sell a lot of books. But again, as I mentioned, this whole system is built to keep you in the dark about how credit works, so that you don't know how it necessarily operates. So don't feel bad that you didn't learn it in school about what the perfect credit profile looks like, how many credit cards to have, because that's just simply not information they're going to share with you. But I'm going to tell it to you. So credit is used for virtually everything. If you don't have enough credit, you're going to run into headaches. If you have credit, but it's not very good, you're going to run into issues. You can't get things like credit cards. You can't get home loans. If you literally graduate right now and have no credit whatsoever, you can't even rent a car, because you're not going to be able to get a credit card, and they require that in most places. Checking the hotel rooms can be more difficult. We get athletes that, first round draft picks that can't rent apartments because they have no credit, and people are like, I can't rent to you because I don't know whether you're going to pay me back. So credit began really in the 1950s is when it really became a system, and there was a credit scoring algorithm that came out in the 1950s called FICO, Fair Isaac Corporation. They were created ironically to try to level the playing field, so that a bank couldn't turn down someone because of their race or gender or profession. They would just say, how likely are you to pay back the loan? But ironically, it now allows people to be disenfranchised, because if they don't play by this game and this system, they're going to lose more often than not, regardless of whether they're able to pay back the loan. They're just going to look at them and say, we can charge you more money. So there's three main credit bureaus: Equifax, TransUnion, and Experian, the three big bad wolves, essentially. What you probably think they do is provide things like credit monitoring service and resolve issues that you may pose to them. But in reality, what they do is they collect data on you and sell it for profit. So John Oliver has a great statement on this, in which he says, when you walk into Kentucky Fried Chicken and you want to know what's on the menu, you're thinking, well, chicken in the buckets, right? Well, in this case, you are the product. You're the chicken in the bucket that's being sold. And all these stores and banks will buy this data from them to say, how do you use your credit? Do you repay it back? What kind of line of credit should we give you? And should we loan to you at all? So that's how they make their money, is by selling the data on you. They really don't care about you if you say, hey, my information is incorrect, which 25% of Americans have been shown to have these issues. They say, we don't care. If the paying consumer is telling us that this is the way it is, then that's the way we're going to report it. And now what makes up your FICO score is a real surprise, because it was kept secret from the 50s when they created it up until the 90s, and a bank accidentally released the model to it and they got in trouble with FICO. But then the cat was out of the bag, that this is how credit score is created. And it's very important to note that there's only one score that that's worth anything, and that's the FICO score. If you get a free score from any one of these three credit bureaus or from somewhere else, you could get one from, Credit Sesame, Credit Karma, anything like that, your credit card company. They mean nothing unless it's a FICO score. If it ain't FICO, it's a FACO, and you don't want that. You want the actual FICO score. Look for nothing else unless it says FICO. And here's what's actually made up of your FICO score. 35% of it comes down to your payment history. Plain and simple, that's whether you pay your bills on time or not. That makes a lot of sense, that the biggest chunk of what makes up your FICO score is going to come down to whether you pay your bills on time. But what doesn't make sense is that 65% of what makes up your FICO score has absolutely nothing to do with whether you pay your bills on time or not. And that's the part that you can actually control more than that. You know, during the pandemic, a lot of people saw their income, assets suffer, dwindle. They couldn't control whether they could pay their bills on time, but they can control this other 65%. So the next biggest chunk, 30%, comes down to credit card utilization. And this is where it gets a little bit funky, because you may say, hey, I pay my bills in full each month. That doesn't matter to your FICO score. What matters is what the balance is on the day that they report it to the credit bureaus. So you can pay it off in full on the 30th every month, but if they report the balance on the 15th and the 15th it's high, you now look like a credit risk. And this is per credit card or line of credit. So it doesn't matter, you know, for an installment loan, like an auto loan or a mortgage or a student loan, but it does matter when it comes to your individual credit cards and department store cards. So for example, if you have a $500 limit on a Macy's credit card and you put $400 on it, and it shows a $400 balance on the day that you report, or the day that they report to the credit bureaus, you're taking a massive hit to your FICO score, almost as much as if you missed a payment on your credit card. That's how much this really impacts it. And you have to be cognizant that it's only when they report it to the bureaus. And you never know when they're going to report it. Most companies will do it every 30 to 45 days. And I'll cover later on how you can make sure that you have the optimal credit score when you're going to look to apply for your credit. The next chunk is much smaller than that. 15% of your FICO score comes down to the length of credit history that you have. So the longer, the better. You want to think of these as like relationships or friendships that can vouch for you. And if you say, hey, you know, like Schropp hooked me up with Chuck. I've known Schropp for like 10 years. That guy, you know, he could tell you whether I'm really legitimate or not. But someone I just met 6 months ago doesn't have the same weight. And just as important is they want to know that you're touching base with these creditors or your friends on a regular basis. So you want to get together and have a beer with your friend every month rather than say, well, I've known them for 10 years, but we haven't talked in like 2. That doesn't count. And the way to have the equivalent of, you know, having a beer with your friends from a credit perspective is to use your credit cards on a regular basis. I have credit cards that literally just charge up things like my newspaper subscription, and then they zero out at the end of the month. My Netflix subscription, zero out at the end of the month. I would say Spotify, but I'm down with The Rock. So, you know, I support Tidal. My Tidal subscription is paid off automatically in full. And that keeps my credit strong, keeps my utilization very, very, very low. And it says that I'm touching them every month and we're staying friends. So that's what you want to do. The other 10% of your credit score comes down to the variety of credit. You know, do you have just one type of credit, or do you have a mortgage, an auto loan, a student loan, a credit card? They love to see that you can handle a diversity of issues that are being thrown at you, not that you're one-dimensional and you could say, I can only handle credit cards or I only handle student loans. They want to see that you can handle multiple different types of debt. And then finally, the last 10% is what keeps people up at night. Inquiries. Everybody's afraid to have their credit pulled because they say, oh my God, it's gonna drastically lower my credit score if you check it out. And the answer is no, not really, not at all. The average inquiry will impact your credit score by 0 to 2 points, which is not much at all. And I want to give you one quick tip on how to manage that, because they created loopholes for this. They created a loophole for mortgages. You could apply for an unlimited number of mortgages within a 45-day time period, and they will count those 45 or all the inquiries within the 45-day time period as just one inquiry. And one inquiry, as I mentioned, will typically impact your score by 0 to 2 points. And they also created a loophole for auto loans. So you could shop around for auto loans as many times as you want within a 45-day time period. Not going to hurt you. You could apply for a student loan, or you could apply for a rental property. You can't apply for like one of each of those types of categories and count it as one, but it's literally each one of those categories like that, you could apply for a limited number of applications within a 45-day time period, and they count as one, so you ain't got to worry about that. All right, so the last part I want to get into is the FICO score range. A key thing to think about here is that you don't really have just one score, like many people believe they do. You actually have three, because there's one per credit bureau. And FICO is just an algorithm that will look at the data on each credit bureau and then give you a score. And the way that they determine what your score is by literally just taking the median score between the three of them. So let's say you had a 600 score with one bureau, you got a 700 with the next one, and then an 800 with the third. So, you know, do you think they take the 600, the 700, or the 800? They actually just take the one in the middle, which is a 700. Not the average, just literally the median score between those. And what's been considered good throughout time has shifted immensely. So if you had a score of a 640 back when I was doing mortgages, you could get anything you wanted at the best rate. All you had to do was show a pulse and fog up a mirror, and they would give you like $1 million loan back in the day. But then things got a lot tighter. So now what's considered an A+ is a 740. And that's the 740 middle score between the three. If you got above a 740 or A+, you get the best rates for everything, from mortgages, auto loans, credit cards. They're not even using credit scores to determine your home and auto insurance rates. It's pretty insane, all the things that they will weigh into that. So now you know how they're looking at this, what goes into your FICO score. The one thing I didn't tell you is where to get the actual real deal credit report from. And you got to remember that the banks don't play. They're not out there to educate you and teach you about how the system works. They want you to come to them blind and just saying, look, tell me what the rate is and I'll deal with it. So I'm going to tell you a secret website where you can get access to the same credit report that lending institutions use. Because it's not Equifax, it's not Experian, it's not TransUnion, it's not Credit Karma, ain't Credit Sesame. There's only one website where you can get the same credit report that the lending institutions use. It's www.itdoesn'tfriggin'exist.com. It's with 2 G's and an apostrophe. Because the banks ain't playing. They don't want you to have access to this. In fact, when I published my book, I wanted to show a copy of what a real credit report looks like that the lenders look at. And the credit bureau said, we don't want you to do that. You cannot do this. And I went to the lawyers for my publisher and said, can they stop me? They said, no. And I said, then publish away. So in the back of my book, you can literally see what a real credit report looks like. And it ain't nothing like what you see as a consumer. It's very, very different. It's laid out differently. I have a part of the book that even gets into how to read this thing because it's really not meant for consumers. It's not very consumer friendly. So really the way that you can get an accurate report is if you know someone that works for a bank and they'll run your credit, not supposed to, but you do that, you talk friendly to them, they can get you one. Another way is through real estate agents. Real estate agents are everywhere. If you were to turn over a rock right now, you'd probably find 3 real estate agents underneath it. Everywhere. And they get business from, or they give business to mortgage bankers. Mortgage bankers want to keep them happy. So if you ask them for a copy of the credit report, they can get you one in most cases. And that is the best thing to do, is to get one of those reports versus a Credit Karma, Credit Sesame. Those are worth nothing. When people hit up my company and say, I want you to take a look at my credit and tell me where I stand, they are forbidden from giving advice based upon a Credit Karma report, a Credit Sesame report, a credit whatever report. If it ain't the real report that comes from the banks, we can't even check. We can't even provide advice on it. And we do have a method of getting these credit reports, but it costs $50 to get the real deal. where if you go through a real estate agent or reach out to the bank directly and they sweet talk someone into giving it to you, you can do that for free. So that's the basics of credit right there. What goes into a score, how to get the real score, what the perfect credit profile looks like, which is 5 to 7 trade lines that are open 2 years or more. The longer the better. Keeping your credit card balances low. Don't apply for too much credit in a short time period, and you'll be all right. You'll be all right. You don't have to go to Harvard to learn that. You can learn it right here.
Well, thank you, Anthony. So let's break this down a little bit, because I was looking in the chats and I almost started to type also when you said, here is the website. So if we can't get, if we can't
I even got the Harvard kids, you know, and nobody's immune to it.
If we can't get that script, if we can't get that report and we have to rely on something else like Experian or one of the others, which do you suggest, or do you just say whatever you can get for free?
I'd say that it's like handing someone monopoly money and saying, how much money am I worth? Friends don't let friends get fake FICO scores. You got to get the real deal. The real deal or bust. The only thing that credit monitoring is good for is to give you an idea of where your credit score is headed. So if you see that 1 month to the next, your score drops 40 points, then you know something's going wrong. But it's not going to be a good idea to give you an idea where you're at, because they could be 60 points off the real deal. They could be 100 points off the real deal. We see that all the time. That's a significant percentage. So no, you got to get the real deal or nothing at all. Sorry, Julie, did I lose you for a second? I think we lost Julie. So at any rate, yeah, you got to get the real deal, or it's worth nothing. Pay no attention to it. You can't even come to an expert and say, "Tell me what to do with this," because otherwise you're out of luck. They're just not going to, you know, you're not really getting the best advice.
Anthony, I must admit, I clearly understand everything that you've said thus far, and I'm sure our audience does as well. But yet, still, understanding doesn't mean it's not confusing. You know, we don't use this thing every day. You know, we don't run our credit every day. At least I don't think we should. But all being said, there obviously is a system out there that's not working to our advantage. So we need as many points as you can give us to make it work to our advantage. I mean, what do you recommend we do? I mean, what does Jane Doe do tomorrow morning to help, you know, impact her credit score in some way, shape, or form positively, especially for our community, you know? For our community. Yeah.
So the reason why the system doesn't work for our community is that a lot of people don't have a traditional bank account. They don't establish credit in the same way. And you will be in a great position if you do start off by finding out what your real credit report is, or what your real FICO score is. You'll also want to assess whether or not you have the perfect credit profile like I laid out, which would be 5 to 7 trade lines, open 2 years or longer. You want to keep your balances low on your credit cards, because if you're not doing that, that's impacting almost as much as whether you make your payments on time. And then keep those inquiries low, not too many. Don't lose sleep over 1 or 2 here or there. And that will put you in the right foot. You know, that'll get you the right start. You know, if you don't have any credit cards, you want to start by getting a credit card that, you know, what I recommend is get a secured credit card, meaning you put down money. If you put down $200, then your limit's $200, and use that to start. Put a small charge on it, and then, you know, don't use it much more than that. You know, that will get you really started well.
Okay. I see Julie's back, and one of the questions that's not on this list, Julie, I'm going to ask him real quick, because you already said twice now, we're talking about credit utilization. Is that correct? I mean, if you have a $500 credit card and it's $499 on it, you're basically maxed out. That doesn't show well, I would think.
No, and it doesn't matter what your income is. It doesn't matter how much you got in the bank. You could be Jay-Z. If you use a high percentage of your credit card limit, your credit score is going to take a beating.
Okay.
But there is one exception to this rule. I'm glad you brought that up. If you have a charge card with American Express, meaning that you got to pay the balance off in full each month, the balance never impacts your FICO score. It doesn't at all. Negative in any way, shape, or form. So you could put $10,000 on it, you could put $100,000 on it, you could put $5 on it. It's not going to impact your FICO score. Where if you put it on the Visa or MasterCard, it's going to impact your score. Anything above 0 begins to negatively impact you. The closer you put towards 100%, the more crushing it's going to be for your score overall.
First of all, I apologize for getting booted off and losing the connection. I don't know if I missed this, but I was asking which credit company to use. I'm sure you answered that question. And then your conversation just now, was that about whether or not to pay off your card on a monthly basis or not, and how that affects your score?
I'm sorry, you cut out for a second. It was about whether, let me actually address the beginning part. There's nowhere that you can get as a consumer an accurate credit report. Forget it, don't even try.
So then which one should you use to monitor your credit? Because you should still monitor your credit.
Monitoring credit is a good idea. There's tons of free ones out there, just use those. But know that that's only going to be good to tell you about where your score is moving, so you know if there's a problem. It's not going to be good to give you an idea of where your score is at, because it doesn't do that. They're off by tons. I see Marvin's asking, is Credit Karma reliable? Credit Karma is reliable at making money. They make a ton of money, because basically what you're doing is, in order to get a free score, which is again a FACO score, they're like, hey, let us collect all this data on you. Let us see how you spend your money. You could tie in your bank accounts if you wanted to, so you can categorize how you're spending your money. You could tie in your credit so we can see all your creditors. And then they're going to sell you stuff based upon that. That's what they're reliable for. As far as the score is concerned, don't touch it. Don't touch it. I see a question about.
I'm sorry. Yeah, you're seeing those same questions I'm seeing. Which one did you want to tackle?
How many credit cards are too many? All right, I'm going to tell you a joke from my seminars. There are two types of institutions that can loan you money and change the terms at will. Two types of institutions that can loan you money and then change the terms at will, meaning whenever they want to. One are credit card companies. They can do that. They can say, you know what, Julie? I don't like your school that you went to. I like another school. So your interest rate's going to go up. You know who the other institution is that can do that? The mafia. That's what you got. So credit card companies, like, I'm not a fan of them at all, but you gotta have a few to play the game. So how many cards are too many? Again, the perfect credit profile has between 5 and 7 total trade lines. And a trade line is anything that reports to the credit bureaus. That could be a credit card, it could be an auto loan, it could be a student loan. So you want to have a mix between all those different types of things. So out of those 5 to 7, you probably only want to have a couple or 3 that are credit cards, if that. But the average American has something like 9. It's insane, which is way too many. Way too many.
Okay, so we know that 9 is way too many and 1 is probably too few. So you're saying about you're saying about 3, and then paying it off versus letting the interest pile up.
Yeah, I know. I get asked that a lot. People are like, I hear it's not a good idea for you to pay off your balance in full each month. I'm like, is that from your credit card company who's telling you, no, pay interest pay interest. It's good for you. It's good for your credit. It's good for me. No, you want to pay it off in full each month and not pay interest. Not pay interest.
Okay. So is there something that I should not be doing that's keeping my credit score from not improving?
Something you should not do. Yes, this is going to sound funky again. None of what I say is going to make any sense. Just trust me, it makes money. But if you have an open collection on your credit report and you decide to pay it, that's like admitting guilt. It crushes your FICO score, and then it's going to remain that way for 7 years. So it actually lowers your score to pay an open collection, unless they agree to delete the late payment or collection in exchange for the money. If they don't agree to delete it, don't agree to pay it.
Can you break that down? Because I think that I missed something here.
It doesn't make any sense, right? You're like, this doesn't make sense. You're like, I owe the debt, I'll pay it, and then you're going to penalize me for it? Yeah, that's right. Because the way it's viewed is, and you know, this is for all the married guys out there. Think of when your wife is mad at you, right? Or what she's mad at you about. It's not a matter of when you did whatever this activity is. It's a matter of when she last remembered it. Does that make sense? So you could have been like acting a fool 3 years ago, but if she remembered it last month, that's going to hurt your credibility. So it's the same exact way. And only married guys get this one. They're always like, yep, I get it. I get it. So that's the way it works when it comes to a collection. If you pay it, it reminds them that you ran afoul of them and you did something you weren't supposed to do. You stayed out late with the homies. And so it's going to hurt your score.
So late payments also hurt your score.
Late payments hurt your score by more than anything else, but just barely over credit card balances.
So you should really just, if you have any issues, you should try to negotiate with your credit card company so that you're not having a late payment. Okay.
Not get a late payment, or if it gets to a collection, that you'll pay it if they delete it in full.
Okay. Now a question that someone asked in the chat, and it was also on my list. Can a company not hire you because you have bad credit? Can they run a credit check and okay, and
I think we lost Julie again.
They just run a credit check on you. It shows that.
Yeah, so they're not allowed to look at your score, but they can definitely look at your credit report and say, this person owes a lot of money. They might be financially irresponsible. We don't want to take them on as an employee. That is legal to do. They just can't look at your score. They can't request it, but they can get an idea from looking at your credit report. Interestingly, there's no correlation between whether you have a good score or a bad score as to whether or not you're going to be a good employee or a bad employee. None whatsoever.
So if you think something is wrong on your credit score, on your credit report, how do you get that fixed? I mean, is there a way to go to bat with these credit reporting agencies to get it fixed? Yeah,
but I've got bad news for you. So I'm sure you're thinking, like, Julie, you got your game on point. Like, I know you got your credit good, right? But if someone were to make an error on your credit report, you're going to be like, I'm going to write to them. I'm going to write to the credit bureaus and say, I'm Julie. I don't play.
Well, I would be calling, but.
Okay, call. Same thing. Let's pretend that you mail a letter, because it's better for this analogy. So you mail a letter to them. I know you're envisioning that there's this big room full of people opening these envelopes and pouring through it and going, oh, we made a mistake with Julie? Girl, you better get that right. No, there's no such room like that. There's no Easter Bunny and there's no Santa Claus. All they do is they have a computer scan these letters and kick out a 2-digit number to give you a response. I know you're thinking that can't be the truth, but no. I'm like the Grinch when it comes to credit. I'm just telling you how it really is. You know, I'm not here to tell you how it should be. And they 9 times out of 10, they're not going to resolve it that way. I'm not really trying to just pitch my book here, but I literally have a whole chapter on like how to recover from disaster, and it gets into like the anatomy of a dispute letter, how to do it. You got to make it so that it actually does get to a human, which is tricky. But if you can get it to a human, you're much more likely to get it resolved than if you just have it kicked out through that computer system.
So you're bringing up an interesting point, and someone asked this as well. Do credit repair agencies really help improve your score, or is that just a waste of money?
They can. I'll tell you that you only want to go to companies that have good ratings. You only want to go to companies that will offer you money back if they don't get results in a certain time period. And you only want to go to companies that are actually going to take a look at your credit report before signing you up. So like the biggest company in credit repair is lexingtonlaw.com or creditrepair.com. You don't have to talk to anyone for them to sign you up. You can literally go to their website right now and say, sign me up, and they'll take your money without knowing whether or not they can get anything off. That's not right. You want to talk to someone who first is going to look it over and say, what are your issues? What are you trying to do? Can I help you get there? Yes or no? Credit repair is a small percentage of what we do now, even though that's what we started off doing. But we turn down a lot of files because we look at something and say, what are you trying to do? How soon are you trying to do it? Let me take a look at your credit. I don't think I can get you where you want to go. So you just need to keep doing what you're doing because it ain't going to be worth your money to do it. That's the kind of company you want to work with.
Okay, so maybe this is a good time to ask the difference between good debt and bad debt, and hopefully that'll cover some of the questions in the chat box as well.
Yeah, good credit or good debt is something like a mortgage. It's something that you're basically using other people's money. It's like OPP, but when it comes to credit and debt, right? So you're taking other people's money and you're saying, you know what, I'm going to borrow $500,000 from you to get this house, but I'm willing to bet that the house is going to increase in value above what I pay you in interest. That's good debt. Bad debt is something like a car loan, because that is a depreciating asset, which means you owe more interest over time, but the value of the asset is declining over time. So interest goes like this, value goes like that. That is bad, bad, bad debt. And credit card debt is always bad. It is always bad. You don't want to carry over interest, over time. It's much better to just build an emergency savings account and try to draw from that as you need money, rather than say, I have an emergency, let me put it on my credit card. Bad, bad, bad debt.
And you mentioned that when people say to you, I want to get to here, and you tell them realistically, there's nothing you can do. They just have to keep doing what they're doing. What is sort of the number one thing that you can tell people to keep doing to improve their score? Is there one thing?
Yeah, we always say, pay down your credit card debt and keep it low, because that will ensure that you have a high credit score for any time you want to use something. I promised that I'd say, how to make sure your credit is in line when you're looking to use it. And the key is 60 days before you're going to apply for financing, you want to zero it out. You want to zero out any credit card balances that are not an Amex charge card. And then you want to refrain from using it, or you want to continuously pay it down multiple times a week so that your utilization never gets too high. And then when they look to pull your credit 60 days later, you're putting yourself in the best position possible.
So that brings us to another question. The difference between Visa, MasterCard, which are basically the same, and then Amex, which is different. You mentioned anything but Amex. You want to zero out anything but Amex. So let's talk about the differences, and if it's better to have one or the other, or should you just have both, since you're going to have 3 credit cards anyway?
You should have both. I do. I got a Visa, MasterCard, and an American Express. Actually, I got 2 American Express cards, but that's a long story. One's for the business, one's for personal.
You have me beat by one, because I have Visa, MasterCard, and Amex. And I finally gave in and did Amex because they're doing the cash back card.
Look, I think, you know, as far as mafia members are concerned, Amex is the best of the bunch because they go to bat for their consumers. You could say like, look, this company did me wrong, it did me dirty, and they'll be like, look, we're gonna take the money back from them and give it back to you, no questions asked. They do that better than anybody else.
Right, because the other credit card companies are now more on the business side, siding more with the businesses than with the consumers.
Yep. Or Amex is like, nope, we don't play. You dispute it, money's coming out.
So how if you have children, at what age should you be giving them a credit card and teaching them about this?
Oh, that's a real good question. That's a real good question.
Because if you have a latchkey kid in New York or in another major city, wouldn't you want them to have a card to just know that they're, you know, if they're going out, if they're taking the subway to school or whatever, not on a school bus, that they have something just in case?
Now, you're not supposed to be able to get someone a credit card who's under the age of 18. And I don't recommend that as a good tool. Like when I went off to college, my parents gave me an American Express card to use for emergencies, which turned into like, I got a beer emergency, I got a pizza emergency, I'm trying to impress this girl emergency, like, you know, whatever it was. But, you know, what you can do, and what I think is a better practice, is to give them what's called a green light card. I got this for my kids. I'm about to give my 6-year-old one for Christmas so he can join his 2 older brothers in having it. But a green light card teaches them financial responsibility. Like they can get money for earning chores. You can keep it there and they check it off. And then it's like, all right, sends me a message saying, hey, your kid wants to spend $10 at Nintendo. Are you approving of that? Yes or no? They can log in and see their balance from their own mobile device. So it's like, all right, you know, I'm telling my 12-year-old now, you're going to the movie with your friends. You're going to buy a ticket. You're going to buy a drink or popcorn. Well, you need to log in and check to see how much money you got. You know, do you have enough money for that? And I set it up so that out of like every dollar that they make, 70 cents goes to spending whatever they want on whatever they want and whenever they want it. 20% of it needs to go to savings, which is for long-term savings. So that could be like if an Xbox controller breaks, if their iPad screen breaks, if something needs replacing, I'm not paying for it. So they have to put that money in savings, and they have to have a certain amount in their savings to be able to go forward. And then 10% of it goes to charity. And they have a whole host of charities that you could determine the money's going to go to. It makes it really simple and easy. So there's also ways to teach them about the stock market through Greenlight. I'm not paid by Greenlight. I'm just telling you, you know, but you could teach them about the stock market. You could teach them about compounding interest, which I find interesting because then they also see the flip side of that, which is, what if a credit card company is earning compounding interest on me? That ain't good. But if I can put, and they see the power of like, if I have $100 in savings and that's earning interest at the end of that month, I may have $101. That's good. But they can see how it works with credit card companies too, and that they can make that same money off of you at a much higher rate usually. So I'm a big fan of that. Give them a green light card. They can use it like any debit or credit card. They can swipe it. They can actually, you could set it whether they pull money out of the ATM or not. You could set a lot of parameters up on it. I'm a big fan.
And we're coming almost to the end, so I want to make sure we get in anything that you think is extremely important that we haven't covered.
Yeah, that's a great question. So I saw someone asking a question which I thought was really great, which is about closing a credit card. Should you close a credit card, especially if you have more than the recommended number? And the answer is, it depends. So it depends on whether you already have that perfect profile, 5 to 7 accounts, open 2 years or longer. If you close a credit card, you lose that relationship, you lose that friendship. So you can say we were friends for 10 years, but now we're done. You lose that credit history. It could actually plummet your score if the card's been open a long time. So if it's been open more than a few years, I'd say keep it. Just try to keep the balance low. If they have, like an annual fee, call them up and see if maybe you can transfer it in the one that doesn't have an annual fee. Keep the card open. Put your Netflix on it. Netflix and chill with that credit card.
So maybe that should go along with the other question of how long should you wait to get a new credit card?
I'm sorry, I didn't hear the first part.
Maybe that should go along with another question in the queue of how long you should wait to get a new credit card. This person is saying, I don't want too many hits on my credit at the same time.
Yeah, I wouldn't worry about that. Again, most inquiries are 0 to 2 points. Don't lose sleep over that. If you want to go out and get those credit cards, go out and get them.
And is now a good time? Are there times that during the year where it's better because the offers are amazing? Sign up, X amount of bonus points, X amount of miles, a lot of different offerings. It's a lot to sort through.
I'm sure that there is, but when it comes to credit cards, I leave it to, what's that guy called? I think he goes by like the credit guy or whatever.
Oh,
the points guy. The points guy.
Yes, the points guy.
He's got every article you'll ever want to know on that. I'm not trying to step into his lane. He knows that hustle, credit cards, rewards, points better than me. I don't.
I do look at that website. I know some people who work over there. Yeah.
Oh yeah.
Yeah. Mm-hmm. So, we've got 2 minutes before I toss it over to someone else for our closing. But I want to say thank you so much. I want to make sure that if you wanted to say one last thing in the minute we have remaining, you get that opportunity.
Yeah. So I've already gotten paid really well to write the book, Your Score. And it's probably the proudest I've ever been of my career, in large part because it allowed me to educate so many people in such a short time period, far more than I could through seminars. I before the pandemic, I was doing 1 to 2 seminars a week, and I'd reach 40 to 50, 100 people at a time. This book is something that everyone should read. I've read that people that reach out to me say, I taught my kids this. I read it, I handed it to my spouse, and now my kid that's going off to college is going to get it. My kid that's getting out of college is going to get it. Financial planners handing it out to people saying, look, do this. You'll have more money to invest with me. I'm biased, obviously, but it's not like I'm going to get more money because you buy more of this book. I'm paid. Don't worry about that. I really feel that it is the best tool to understanding how this whole crazy credit system works. And if you read it and you say, oh, this all makes sense, the credit game makes sense, then I didn't explain it right, because it don't make sense. It's all about making money off of you. I learned that as a banker, so don't trust that smiling banker. Sorry if you are a banker, but that's just the way of the hustle. That's just the way of the hustle.
But it's so important, because if you want to buy a house and need a mortgage, you need a good credit score. And as someone else had asked, and you said, it could stop you from getting a job, having a bad credit score.
Job, insurance, apartments, homes, everything comes down to credit now. It's a hustle. It's a hustle.
Well, thank you so much for taking this time to join us. I want to turn it over now to Andrew Hamilton. He's the president of the New York chapter, the Metro New York chapter of the National Black MBA Association. And I want to bring him in to say a few words. Anthony Davenport, thank you so much for joining us.
Thanks for having me, Julie. It's a real pleasure.
Good evening, everyone. I'd like to thank Julie Walker and Anthony Davenport for their conversation this evening. I took down a lot of notes, so definitely I have your book as well. So I'm definitely going through the book and learning what I need to know. And I just want to reference a couple of things, because a lot of times when you do these programming, you never know where certain things tie back to you or tie back to the work we're doing. So when you mention the scanning of the letters going through the system and you're not getting to a human being, we this group and this organization did a Black think tank earlier this year, and it was about the future of work and the future of technology. So it resonated with me when you said that, saying that again to human being and how those inequities affect our community going forward. So definitely that article is, I believe, is finished, and we should send it out to everyone fairly soon. The other point you brought up was about mortgage bankers and mortgage real estate professionals. We're very blessed as an organization to know two phenomenal real estate professionals, Larissa Longchamp and Vanessa Hawkins, which did a real estate cohort here in the New York area in 2021, and we will do another one in 2022. So if you're looking to invest in real estate, this book should resonate with you as far as getting your, I use a colloquial term, getting your weight up to buy that next dream property of yours. And the last one that I took down note was a greenlit credit cards. And the reason why that resonated with me, because of our Leaders of Tomorrow program, which will begin is, I believe, its 37th, 38th campaign in January. So what you're referencing this evening is real tie into real life work we're doing here as an organization. And I'd like to thank you for giving your tips and insights on this. And I really want to know, hopefully you come back in a future date when, we have some time. But again, this organization is really driven by our members, our community. They're driven by professionals like yourself. One statement always used when this organization still relevant to this day: need meets talent, and talent you see right in front of you is Anthony Davenport. So on behalf of the Metro New York chapter of National Black MBAs, I wish you a very pleasant evening. We have one more online event for tomorrow with our friends from Aveda and Estee Lauder as a natural hair presentation. And that should be very enlightening, because not only they will tell you about the hair industry, but also tell you about the concept of texture. I had a very deep conversation last week about the word texture. So for those who are probably smiling, said, how would a man know about texture? Believe me, I got a very in-depth explanation of texture last week, and I can't wait for you to hear it tomorrow. And the last and not least, their sustainability program globally will discuss about clean water. So especially with the old infrastructure bill that Joe Biden just signed yesterday, it's very interesting in how companies like them, how they lean forward and able to give back to our global community. So thanks again. This recording will be available very soon. Thanks again, Anthony Davenport, Ms. Julie Walker. Thank again, Chuck Roberts, for his leadership, and Marvin Vasquez, and the rest of our Metro New York Black MBA board members. And I believe that is it. So thank you.
Thanks for having me, Andrew.
No problem. Thanks, Julie.
Have a good
Thank
one,
you.
brother.
Thank you as well.